Hello traders, welcome to my YouTube channel. My name is Trader, and in today's video I would like to talk about the topic: how do I invest my trading profits? Now, some might say, sure, that's interesting, but before I invest my trading profits, I have to have some trading profits. And that's of course correct. You should first have a successful strategy which makes you gains on a consistent basis. And then you should make enough money so that you can invest those profits. Even if you haven't yet started earning consistently, this is an issue. And once you start to earn money with your trading strategy, you will sooner or later be confronted with the question, okay, what now? What do I do with the money? And that's what this video is about today. I would like to show you how I do it. I'm not saying this is the only way or this is how you should do it. That's not what this is about. But maybe my approach will help you to get an idea of how you might want to do it. Look, I've divided the way I trade money into two blocks. You can see it here, what I call my money cycle. There is an offensive part in the way I manage my money, and there is a defensive part. You see on the left the offensive side, which is of course is mostly about how to make money in the stock market. And as you might know, I do that mainly with scalping and trading. But there is also another important part which I haven't talked about much, and that is speculation. So I also speculate, and I will tell you in a moment what kind of speculation I do. On the right, then, is the defensive part of my money management. And there, of course, the first thing to learn is how to keep the money. Because earning money through trading or getting money through work is one thing, but keeping the money is not so easy either. And by that, I don't just mean not spending it, but simply, first of all, that it doesn't become less, either in nominal value or in terms of purchasing power. So, in other words, how can I maintain the money, the capital that I have earned through my trading business? But also, how can I generate a cash flow with this money so that I get an income from it? And of course, I'm also already thinking about what you could call my retirement. You see, there it is. Investments in dividend stocks is the best thing I've found so far, as passive income, so to speak, when capital is available. For me, it's really all about dividend stocks. I know very well that some people prefer to invest their money in real estate, and there's nothing wrong with that. That can also be a very, very good investment to build wealth, no question about it. I've just found that for me, that's not my way. Personally, I prefer that my capital, my money, be invested in stocks and in liquid assets that I can sell with a few clicks, so to speak. You can't do that with real estate. That is one of the reasons. There is also another reason. For example, I personally own an Airbnb property, and I can tell you, I've had good guests, but I've also had others that were bad enough that it made me refrain from investing more in real estate or continuing to have more Airbnbs or even permanent tenants. It was just too much stress for me, honestly. I'm not saying you can't have stress with stocks. Of course you can. If they go down, that can be stressful too. But we will see with my strategy that it doesn't have to be that way. So maybe one more point from me here regarding this offensive and defensive money cycle. Investing in dividend stocks, that's something that quite a few people do, and I would recommend it as well. And what I often see is that a lot of people start on the right side of the money cycle. They start with investing in dividend stocks, and then they hope that this portfolio that they build up will grow over time, so that in 15, 20, or 30 years, at some point, they will have a nice income from this portfolio or an additional income for retirement. Look, there's nothing wrong with that, but that's just a very slow method. Many people choose, and it's also often recommended by investment advisors, if it's recommended at all, to invest in dividend stocks. But when it's done, I often see that people then do what is called frugal living, trying to turn over every penny to invest as much as money as possible in their dividend stocks so that this portfolio grows as fast as possible. Yes, that's become a kind of sport. I know that's a whole movement, especially in the United States and in other English speaking countries. These people spend as little as possible, and they believe in this frugal living thing so that they can get to the point as fast as possible where they can live just from the cash flow of the dividends. I wouldn't do it that way. Indeed, most of these people start on the right part of the money cycle. On the defensive part, they start saving $100 or £100 every month, for example, or $50 or $200, depending on how much is available for saving. And they try to slowly, very slowly, build up a dividend portfolio. Okay, I know that the fans of frugal living save much more from their monthly income in order to arrive much faster at the point where they can start to live off their dividends. That's the whole idea of this frugal living movement. As I said, it's not my way. My way is to first start on the left side of the money cycle with the offensive part. The question I ask myself is, how can I make money in a direct, offensive way? And that's real money, I mean real cash. I do this with scalping and trading and speculating. And then, what's left over, what I do not need to make a living, that I immediately invest in my dividend stocks. This way, I can tell you, your stock portfolio will grow much faster than if you try to save $100 every month from your salary. Or even if you try to save 50% of your salary or even more, which some people in the frugal living movement are able to do. I have nothing against this way of doing it. If you can do it, just do it. But that way, your path to freedom is slow. And there is another point. If you do it that way, you create a kind of scarcity mentality. You will save every penny you have, and you will, for instance, forbid yourself to have a nice coffee in your favorite coffee shop, which is something I do almost daily because I like to drink a lot of coffees, and I like to discover new and exciting coffee shops wherever I am. You see, on the one hand, you have the scarcity mentality, and on the other hand, you have people like me who believe instead that we are living in an abundant world where there is enough money for everybody. We do not believe in this scarcity mindset. In my opinion, there is a much faster and more efficient way to get to that financial independence, which is what we all want in the end. And that is what I'm going to show you right now. So let's go back to the offensive part of the money cycle. Most of you know me here because of my Scalping is Fun book or my scalping course, which has the same name. As you may know, I have developed a scalping strategy that I mainly do on the DAX, the Dow Jones, and the Euro dollar. And that is actually how I make most of my money. And it's just fun. If you're interested in this method, you can check out the course. You just need to click on the link below this video. There you will find a free workshop where I explain how I do it. But there is also a second source of income, and that is strong trends. When I see a trend somewhere on the stock market that I suspect could continue, so in other words, a trend that where I see strong fundamental reasons why it exists, then I can start to build a big position in that trend. It can be a stock, but it can also be an index. It can also be commodities and also currencies. I wrote about this experience, how I do it, in this book here. The book is called How to Turn $5,000 into a Million. The idea is to turn a relatively small amount of capital into a significant sum. And it is possible. In the course of my trading life, I have succeeded several times in actually making big gains with strong trends, starting with just a few $1,000s. And to do that, I use a scaling in, scaling out technique. In other words, I start buying, and if my assessment is confirmed by the market, I buy more. So I buy into strength. If I go long, of course. If I go short, it's the other way around. If the market continues to fall, I would sell more contracts. And so, in a particular market, I may be in with 10, 15, or 20 contracts. It's a risky method, and it's not for everyone, but it can, if done correctly, be very profitable. I explain all that in the book. These kinds of trades can really lead to larger gains, say 40,000, 50,000, up to $100,000 profit with just one trade. Such opportunities do not come often, of course. They happen every now and then. There are maybe some very, very good opportunities every year in certain markets. For example, during the financial crisis, I was fully long in the silver market, and I think I made something like $45,000 profit on that one single trade. Another trade was, for example, in the crypto market. I was long there as well. In several cryptocurrencies, I started buying at the end of 2020 and into the first quarter of 2021. And there I made about 400% overall on the capital. That was also a very good profit. It was a little over $60,000 profit with that trade. It's quite possible to make money in this way as well. These are pure speculations by betting on important trends and building up significant positions in those trends. And of course, it's clear that if you can put this money aside and reallocate it to your dividend portfolio, then your stock portfolio can grow much faster than if you save, say, just $100 of your salary every month and then invest it. I hope you see the difference. So, how do I do it? So we'll go back to the defensive part from my money cycle, and you can see it here. I also wrote a book about it because when I'm interested in something, I like to write a book about it. Stocks are fun, becoming financially free with dividends. It's a kind of basic book on dividend investing. It's a book that a lot of people don't have on their radar yet, but I would like to recommend it here as well. I think it's a good book for those people who are interested in dividend stocks. First and foremost, how can you grow a dividend portfolio faster if you invest in higher dividend stocks? How can this be done in a more efficient way than how it is normally done? Conventional way might give you 2, 3, 3.5, 4, or at best 5% dividend yield a year. That's not bad. Obviously, you're not going to be able to grow your portfolio quickly with that. I think that's clear. In other words, we do need much higher yields to really get to the point of financial freedom faster. By higher yields, I mean dividend yields starting at 7, 8% or upwards. You can find those yields in stocks, especially in the American market. We also have real estate stocks, which are called REITs. These are real estate investment trusts. And the advantage of these trusts is, for example, that 90% of the income has to be distributed to the investors. So in other words, much higher dividends are possible here for investors. There are different types of REITs. First, there are the classic residential REITs. This is when the fund simply invests in residential real estate. There are mortgage REITs, and you also have retail REITs. So in all kinds of different sectors, there are REITs. They are interesting stocks, in my opinion. Then there are also dividend ETFs. I don't want to go too deep into it right now, because that would actually require its own video. So with these dividend ETFs, additional income is created by the management, for instance by selling options on securities which the ETF holds. The fund buys shares and then sells covered calls, generating additional income that way. And of course, the consequence of this is that the dividends in these ETFs are larger or higher, often 9% or even 10% annual dividend yields. The same happens in so-called covered call ETFs. That's something to look at as well. What I also like to buy are closed-end funds, CEFs. By the way, these funds are actually very old and have been around for a very, very long time. Some people think these are new inventions and therefore they are risky investments. In truth, they are much older than the usual mutual funds. It actually works like in conventional mutual funds, except that the portfolio is closed. That is why they are called closed-end funds. That also means, thanks to the leverage they have, that the dividend yield is generally higher than in the case of the usual dividend stocks. The same applies to business development companies, BDCs. I have quite a lot of them in my portfolio. They are a form of unregistered closed-end investment companies in the United States that invest in small and mid-sized businesses. They were created to provide small and growing companies access to capital and to enable private equity funds to access public capital markets. Then you can also buy preferred shares, and these also have a higher dividend. It's actually kind of a mix between a stock and a bond. So it has the advantages of both combined into one. It's a hybrid security. Quite interesting. Often, those are distributed quarterly, but there are also monthly payers on these preferred shares. And last but not least, MLPs, which are master limited partnerships. With these MLPs, they are often invested in oil and gas companies. In other words, these are very long-term commitments, very long-term investments. Here, the risks are manageable. But the big advantage, of course, of these MLPs is the continuous cash flow that these MLPs pay out. So from that point of view, these are very interesting stocks for income investors like me. Of course, this list is not complete, but it contains certainly the most important types of stocks or funds that I invest in and that generate a steady cash flow or income. Since I don't rely on that income right now, I obviously have the ability to continue to grow that portfolio by just reinvesting the dividends. And that, of course, is the turbo for a portfolio. If everything that comes in, that is, what I invest through my trading business, and in addition to the dividends that come in, is reinvested, you can imagine that such a portfolio grows much, much faster than a conventional stock portfolio. I try to invest in high dividend stocks or funds where the cash flow is not only coming regularly, but also as high as possible. So that is one point. Then there is another point I want to make here: how I invest. You see it here. I invest by dollar cost averaging. So I have no problem at all buying again a stock that I already hold when the stock is down 30 or 40%. So if I am convinced of the share, that is of the company, if the price falls 30, 40 or even more percent, then I simply will buy more of it. This is called dollar cost averaging. You see it here on the right. Let's say you buy $300 worth of stock every time. If the stock costs $30, well, then you can only buy 10 shares. If the stock drops to $10, which would be an extreme drop, of course, then you could buy 30 shares. If it is at $20, then you can buy 15 shares, etc. So the idea is that you don't buy the position in your stocks and in your funds all at once. Whatever you want to invest in one particular stock or a fund, if I want to invest $5,000, for instance, I'm not buying it all at once, but just allowing myself the time to buy more of the stock when it gets cheaper. And these opportunities occur all the time, as we might know. There are always times when the stock market goes down 10, 15 or 20% or even more, or when individual stocks or funds go down. And then the moment has come to increase your position and just buy more. This way, you don't have to be afraid of losses, except, of course, the risk of a total loss. That is, if the company were to go out of business. That can happen, and that is also the reason why you should diversify, of course, in a stock portfolio like this. You shouldn't put everything into one stock, but you should hold 20, 30, or up to 40, 50 positions, especially if the capital gets bigger. That way, you have a maximum of 1, 2, or 3% invested in one stock or one fund. In other words, if a company in which you are invested goes into bankruptcy, then you might have a 2% loss. That is something you can get over. So from that point of view, I am very conservative and I'm completely independent in my timing, which I'm not with my trading. In trading, timing is totally important. In long-term income investing, timing is not so important. It really doesn't matter. So if I buy a stock today at 30 and in 2 months it's at, let's say, 20, I just buy more of it, no problem. So that is the idea, that you try to get the entry price cheaper, so to speak. Since the cheaper the stock or the fund is, the more shares or units I can buy, and the higher my dividends will be. So basically, it's actually good for a dividend investor when the stock market goes down. It's more of an advantage. We have had for many years the problem of still finding cheap stocks at all. It's getting better now. I'm making this video in 2023, but as for me, I would have not a problem if the market went down another 20%. Then I could buy very good dividend stocks at significant discounts of 30, 40, or even over 50%. That is why it also makes sense to hold a portion of your capital in cash. That is what I do. I actually have quite a large part in cash at this moment and tend to wait and see. That is also part of long-term investing, that you don't necessarily always have to be 100% invested. So dollar cost averaging is part of that dividend strategy. But there is a second important part, and that is monthly dividends. It's much more fun if I get money every month. It really motivates you to go on investing in dividend stocks when the dividends are coming in every month. I actually almost always look for a monthly payer as a rule. They exist in stocks, they exist in CEFs, they exist in MLPs, and they exist in REITs. There are also enough funds and stocks around the world that pay dividends every single month. So when you realize that every month there's money coming into your account from all kinds of sources, that's really a lot of joy to deal with this dividend portfolio. But there is another important reason why I prefer monthly payers over quarterly payers. It's not only about the emotional advantage. Of course, you could argue, does it really make a difference whether you get the dividend paid on a quarterly basis, say 30 cents, or whether you get that neatly dividend into 10 cents per month? The answer is, it does make a difference, and there are studies on this. Look at this graph here. Research found that after 6 years, the difference between a monthly payer versus a quarterly payer is already 50% in favor of the monthly payer. In the first few years, you do not really see the difference, but after 10 years, it's already 100% more payout. That makes a difference, and after 20 years, the curve starts to rise exponentially. And that is the reason why I say I'm going for monthly payers first and foremost. If there's not a good monthly payer and there are quarterly payers, it's also good for me, so I get the dividend every 3 months. But if I can, I always prefer the monthly payer because of this mathematical fact that you see here. There's also maybe a third reason why I do this that way, why I don't go for the dividend growth, for example. Dividend growth is a strategy that's also good, but I would recommend it more for younger people. If someone still has an investment horizon of, let's say, 25, 30, or even 35 years, so very young people, if someone still has such a working time ahead of them before they retire, then it might be interesting to choose this strategy. In other words, to focus more on dividend growth. That means that you pay attention to the fact that the company increases the dividend annually or semi-annually or whatever, and that continues over several years. Because it can happen that a stock that you may have bought at some point where the dividend was, let's say, 2.5%, that after many years, in relation to the original capital invested, you could actually have a dividend yield of 10 or even 15%. That is interesting, of course, no question, if you have that time frame to work with. But for me, I'm already over 50 and I would actually like to be able to live off my portfolio pretty soon. I don't have to because I have enough income from my trading business. I don't depend on it, but as an additional retirement income, it's interesting for me. And that's why I bet more on high dividend stocks. So I'm betting on direct cash flow. I want to have the money now and not in 25 years. So you have to make that distinction. There should be a difference in the investment style between somebody who is 25 or 55. There is also a third component to my dividend strategy. Take profits. You've got to sell a stock every once in a while. So for me, stocks are not for the eternity, as they say sometimes. There can be several reasons why you can or maybe should sell a dividend stock, even a good dividend stock, by the way. One reason could be, for example, if the stock has a multiple of the annual dividend in price gains. If you have 2 years of dividend income in price gains, so if the share has, let's say, 50, 60, or even 70% capital appreciation, then perhaps the time has come to think about taking profits or at least partial profit. If the stock has over 100% profit, then you should take the money off the table or at least set a stop loss so you can realize the profits. Another reason could be that the stock, because of the profits and because of the reinvested dividends, takes up too large a share of your portfolio. That is always a certain risk. So that could be a reason as well to sell the stock. And again, as with my speculative strategy, I use not only the scaling in or dollar cost averaging strategy, but also a scaling out strategy. I would sell, for example, 50% of the stock. I would just take out the money and let the rest run. And this 50%, which I have then realized, I can invest again in other stocks that are cheaper or that have a higher dividend yield. For example, if a certain stock I own is down 20%, then I can buy another position there. So that is my dividend income strategy in a nutshell. That is the defensive part of my money cycle. So actively, I try to make money in as short a time as possible through trading. I have a trading business, and with that money, I kind of feed my retirement, my stock portfolio, which is more of a defensive nature through dividend stocks. Then, as you have seen, I also actively manage these dividend stocks. I'm not day trading here, that's not the point. Some stocks or funds might stay in my portfolio for years, but I've given a few reasons why sometimes you should think about taking profit and why you should sell a stock from time to time. I hope you got something out of this video and would be interested to hear what you think. And if you feel like it, you can share your comments in the comment section below this video here on YouTube. I look forward to the discussion. Take care, and I wish you much success in the stock market.